Welcome back to the SAT System channel, where we focus on regimes, not headlines, and position capital for long-term compounding. On January 30th, 2026, President Donald Trump nominated Kevin Warsh to succeed Jerome Powell as chair of the Federal Reserve. This isn't cosmetic. It signals a new monetary regime, discipline, productivity, and credibility instead of perpetual emergency liquidity. 3 questions for investors. What does a Warsh-led Fed mean for markets? How does Bitcoin fit in? How do we deploy capital when volatility replaces easy money? Let's break it down. Who is Kevin Warsh? Kevin Warsh was a Federal Reserve governor from 2006 to 2011, serving through the global financial crisis. Back then, he was an inflation hawk and a strong critic of unchecked balance sheet expansion. Since leaving the Fed, he built deep market credibility. Senior roles at Morgan Stanley, advisor to macro legend Stanley Druckenmiller, and academic work at Stanford's Hoover Institution. This rare mixed policy experience plus real capital markets insight makes him trusted by investors. Warsh's monetary philosophy. Warsh's beliefs are clear and consistent. The Fed must stick strictly to its dual mandate price stability and maximum employment, nothing more. Mission creep destroys credibility. The Fed shouldn't manage asset prices, climate policy, or social outcomes. Balance sheets matter. QE isn't free money. It distorts capital allocation and inflates bubbles. Structurally hawkish? Yes. But tactically flexible? Also yes. That's the nuance that matters. What changed since 2008? Warsh today isn't the same as in 2009. His focus has shifted to productivity, not stimulus. He believes AI, automation, deregulation, and capital investment can lift real economic output without reigniting inflation. So he now supports meaningful rate cuts in 2026 not as emergency stimulus, but as earned normalization when productivity allows it. Plain English, higher productivity means the Fed can lower rates while keeping price stability intact. This changes the Fed's role from liquidity provider to credibility anchor. Market reaction to the nomination. Markets reacted cautiously, but constructively. Bond yields rose, especially longer term. The yield curve steepened. The U.S. dollar strengthened. Equities stayed calm with modest upside. Gold and silver sold off sharply. Crypto saw short-term risk-off pressure. The S&P 500 never panicked. Why? Warsh signals policy credibility, not chaos. Markets are repricing expectations, not exiting the bull cycle. In Warsh's view on Bitcoin and crypto, Warsh separates Bitcoin from speculative crypto. He's criticized how ultra-easy policy inflated bubbles, including parts of crypto, but the issue is liquidity distortion, not Bitcoin itself. Key takeaways: he is not anti-Bitcoin. He is anti-bubble, anti-leverage, and anti-policy distortion. He strongly opposes a U.S. CBDC due to privacy and state overreach risks. By rejecting CBDC, he preserves space for private decentralized alternatives. Bitcoin stands alone here. Under a Warsh Fed, monetary credibility strengthens, regulatory clarity improves, and fraud leverage-dependent tokens get squeezed. Bitcoin separates further from the broader crypto noise. The next 2 years under a Warsh Fed. If confirmed, expect this path. Monetary policy, gradual conditional rate cuts, faster balance sheet runoff, no automatic Fed put. Growth. AI-driven productivity pushes GDP toward 3 to 4%, benefiting manufacturing and reshoring. Stronger dollar pressures exports, but stabilizes purchasing power. Inflation and labor, anchored near 2%. Unemployment steady around 4%. Wage growth from productivity, not leverage. Coordination with Treasury, possibly Scott Bessent, adds pro-business support. Investor strategy, TDCA in a Warsh regime. This environment isn't for leverage or chasing tops. It's perfect for TDCA, triple DCA, the core accumulation framework we use at SAT System. How it works. Base DCA. Fixed regular investments into high-quality assets like U.S. equities, Bitcoin, and AI infrastructure. Volatility trigger. When markets correct 10 to 15% from highs, double or triple the next allocation. Regime discipline. No leverage, no margin, only deploy when volatility creates opportunity. Why TDCA fits Warsh? Reduced melt-ups mean more volatility, but non-systemic. Credible policy prevents crashes, and that creates repeatable buy-the-dip windows. Allocation priorities. Equities gives AI, semiconductors, industrial automation, defense, energy. Bonds gives short-duration treasuries and T-bills. Bitcoin gives long-term core with volatility-enhanced entries. Gold gives tactical only. Speculative crypto gives avoid leverage-dependent projects. In the big picture, a Warsh-led Fed does not mean endless printing, asset inflation at any cost, or bailouts on demand. It does mean monetary credibility, productivity-led growth, and a healthier, longer expansion. For disciplined investors, this isn't bearish. It rewards patience, quality, and volatility-aware deployment. Want the full TDCA playbook, dashboards, and regime strategies? Visit SAATsystem.com and subscribe. We don't chase noise. We position for regimes. See you next episode.